Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, October 18th, 5:16 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, well, the fading is back before the uptrend, which we're in since the O'Neill methodology follow-through day as of October 6th, as we continue to the market's really being bipolar, having a good up day, a good down day, a down day with a great recovery, an up day with a sell-off, and just can't really figure out what it wants to do. We'll take a look at the charts momentarily, and you'll see what I mean by that. Market leaders sticking to neutral despite the bad day. So far of the 21 over 21, only three have pierced the 21-day moving average. So holding up okay, not making any progress. You don't want to be pouring money into leaders when the market can't make up its mind and is in a trading range, and there's been no follow through after the initial upside to the rally attempt that started on 10-6. Short-term things got a little bit worse today. Mid caps in the Dow went above their 21-day yesterday, failed miserably at that level. And in fact, S&P 500 and the NASDAQ 100 with their first close back below the 21-day too. If that continues to get a second close below there tomorrow, this arrow will be going from neutral back to bearish just after one day after putting a green sub arrow on here because of some optimism over yesterday's action. Medium term, NASDAQ 100 also broke the 50-day moving average. Red arrow in force there. Long term still mixed. Dow back below the 200. Mid and small caps camped below their 200-day moving average. S&P 500 and NASDAQ 100 firmly above the 200-day moving average. So what happened today? Well, overnight yields spiked. So we were, and I say we, I mean the market, the futures were down, gap down right out of the gate. S&P gap down 0.4%, NASDAQ 100 down 0.6, and even worse, small caps gap down 0.9%. Before the open, Morgan Stanley reported earnings, and we've seen a couple of gaps up on big bank earnings since late last week, but every one of them has faded. And Morgan Stanley got hit hard today, so that took banks down. Banks are a big component of the Russell 2000, and bad news, it trickles across the sector very often, and certainly in this case it did. So broad selling at the open as yields made new highs, and the selling really never let up. There were a couple of attempted rallies during the day. The strength in mid caps and small caps that we saw yesterday, they were just as weak, giving back all of those gains and then some. Big Seven also weak on Nvidia and Tesla. RG8 also weak after one day of strength yesterday. Just not a good tape. Not making new recent lows. That's the good sign. We're still above the lows from 10.6, 10.5 when we kicked off that rally. And that was right near the 200-day moving average, but we continue to trickle back closer to that rising 200-day moving average. That's where the rubber will meet the road if we get there. And this will all be apparent when we take a look at the charts. But here are the numbers on the day. Big Seven down 2.3%. Our 8 growth ETF composite down 2.4%. S&P down 1.34. NASDAQ 100 down 1.3. Dow down 1%, mid caps down 2.2, Russell 2000 down 2.1, Global 6040 down 0.98. With yields up, bond prices were down, and globally stocks were down as well. In-house GROTECTION took it on the chin, down 1.25%. One change made to the portfolio today. I will detail that when we get into the tail of the tape, but let's start off with the S&P 500. This 30-minute chart shows it pretty easily. I drew a lot of lines on this yesterday to explain exactly what we were looking for, and here's what we got. So let me redraw this one. That was terrible. So after the failed breakout above 43.85 on Tuesday, we just trended down all day today. I had this line drawn around 33.20-ish that I talked about, where we undercut and reclaimed on October 13th, and that's where we got back above as part of the rally after the follow-through day on October 9th. We closed under that level today, under 43.20, but did bounce at 4,300. If you'll remember back to the 7-layer burrito of support, that's this area here from 4,300 to 4320-ish, and that's where we are right now. So it'll be critical if we break below the 4,300 level. Even worse, making new lows. And hey, this is another 2% lower, but this is where the rising 200-day moving average will come into play down around these levels here. You'll see the 200 EMA when we get back to the daily chart. But so for now, the bad news, we broke below that 4320 level. We are back above it after hours, and I'll talk about that when we get to the tail of the tape as to why we're back above it. But I don't want to get ahead of myself here. So here's the S&P 500. Uh, here's the green line, the 21-day moving average, which is it's a reference point at this point. When you're in a trading range and you've got a flat moving average, that moving average really doesn't provide anything more than a resistance or a reference level. It doesn't provide a lot of support or a lot of resistance either way. That's why we were able to get below it, right back above it, below it, right back above it, and then break through it today, but still above these lows down at 42.16. So the 200-day moving average is now up to 42.29. So it's actually above the lows of that pullback before we launched the rally. So multiple levels of support in here, but you get another day like today, and you're right there. The close of today, 2% above the 200-day moving average. That's basically what our portfolio downside is at this point, with our beta being right around 1. And I'll talk about the portfolio change that we made today. So, as I'm fond of saying, and you've heard me say it 100 times, if not more, the market does not get into serious trouble unless we break below the 200-day moving average. That's where all bear markets occur. And from this point, from 4,600 down to 4,200, it's just a little more than a 10% drop. That's actually less than that. It's less than 10% at this point, with the upsloping 21-day moving average at the high. And this is typical of what we see at the high. We are 11.5% above the 200-day moving average. And anytime you go into a bear market, it's between 10 and 12% normally is where you start heading lower. Those 10% drawdowns happen several times a year in the market. They're not bad. They're not difficult to come back from once you get the right market. But of course, we need the right market. It's when you're down here, when you're down 15, 20, 25 or more percent with the bear market stats that I've shown over and over again. That's when you really have your work cut out for you to get your portfolio back to where it needs to be. Let's move on to the NASDAQ 100. Very similar setup on the 30-minute chart here, and the reference point was 364 that I talked about after the follow-through day. Remember that the NASDAQ 100 did not undercut this level back here on September 27th. That's why we were able to have this follow through day, because we were still on the day count off the low, as opposed to the S&P 500, which made a lower low on 10.3. So that 364 level had been providing support several days, broke through it today. After hours, though, we're back above it. We're at 364.27, and we'll talk about the earnings reports that are driving that bounce after hours. You can see up 0.27% after hours, so a decent pop there, which would make this a possible just undercut and reclaim the next day, meaning it would be a false breakdown. And very often those put in the bottom, we're always on the lookout for those. Let's go to the daily chart on this, and you can see we broke below the red line, the 50-day moving average, the green line, the 21-day moving average. Where are those levels? The 21-day moving average is at 365.38 and the 50-day at 366. So a little bit more work to get back above those. One thing we'll be watching is whether or not we fail when we get near that level, but that moving average is flattening out. So as I've mentioned, it doesn't provide as much resistance or support when it's flat. That's why you often see the indexes play ping pong around a flat moving average. Go to the Dow Jones Industrial Average. Yesterday, above the 200 and the 21-day gave that up today, so that was a one-day wonder. But notice that we are showing relative strength on the Dow, which is typical as this is a more defensive index, and the leading stock in the Dow, United Healthcare, is very highly priced and is rallying since its earnings reports. That's given the Dow a little bit of relative strength. MDY midcaps failure above the 21, one day above does not a rally make. IWM failed yesterday at the declining 21, making lower lows. Well, not lower lows, but 3-day lows after bouncing off this 170 level. This 170 level has provided massive support several times, going all the way back to 10 months ago, back in December. Every time we test it, that's a very clear line in the sand for small caps. Although they're below the 200-day moving average, that 170 level has been providing a lot of support over the last couple of weeks. And look left to be right. That's a technical analysis saying you're seeing that same level provide support multiple times over the past 10 months. Those are the five major indexes. Let's go to the VIX. VIX spiked today, got above 20 and came off a little bit, but so didn't close at the highs despite the ugly action in the indexes. But we're on the wrong side of the 21-day moving average, wrong side of the 200-day moving average, and on the wrong side of that 15 to 16 level where we really prefer it to be. Volatility is increasing. We're up. You'll see that when we get to the tail of the tape. We made new highs on the average true range of the S&P 500. Typically, an increasing range is a headwind for bulls. So there's the VIX. Let's flip to the dollar, not giving us any help either. Daily chart of the dollar, you can see bouncing off the 80 EMA. So we had one down day, a consolidation day, not making new highs, but there's a handle forming here, and it's an ominous looking one. If we break out above this level, that's going to be additional headwinds for stocks. What did this mean for precious metals? First, we'll go to GLD, the standout of the day, up 1.54%. So gapping above this 180 level, above the 200-day moving average, closing mid-range. We've got reference points here above and below today's level. So we had one gap up, 2-day consolidation, another gap up. Serious relative strength being shown by gold. You can see the RS line above, making a new high ahead of price, or actually along with price, I should say. But look where the relative strength was back here when we were at 181, and look where it is now when we're at 181. So very clearly outperforming. We're looking for an entry point into the precious metals, just haven't found one we're comfortable with yet. GDX, negative reversal at this 30 level, still below the 200-day moving average, down on the day. Silver SLV basically flat on the day, getting rejected at the 200-day moving average. Bitcoin, I've been erroneously saying that a spot Bitcoin ETF was approved. It initially, there was a rumor that it was approved. iShares then said no, it didn't happen. I perhaps mistook this with another article that I read about the Department of Justice saying, or the SEC saying, they weren't going to challenge the victory in court by GBTC, which is it's at a discount or at a premium to Bitcoin because it's an ETN at trades over the counter. It's not an ETF that directly tracks price. But you can see this is holding up its break and looks a lot better than BITO. And that's because GBTC, after getting repeatedly rejected in their request to convert to a spot ETF by the SEC, looks like this isn't getting a lot. This isn't getting a lot of publicity, but you can very clearly see the relative strength after repeatedly getting rejected at their request to become a spot ETF. Uh, the tide started turning in their favor, and you can see how much better GBTC looks versus BITO, which hasn't made highs and is still at the lower end of this range in a consolidation. So we'll see how that plays out, but it seems like the SEC finally needs to punt and approve them if they're not going to challenge the GBTC court ruling. Um, we'll see how it plays out. Anyway, let's get to bonds. I'm really taking much longer than I need to here. Here's the broad bond index making lower lows. Not good. Lower lows in price means higher yields. TLT, lower low in price. 0TYX, that is the 30-year yield, making a higher close, not a higher high versus 2 weeks ago, but a higher close. TNX, this is the 10-year, a higher high and a higher close. The 5-year FVX, higher high and a higher close. None of that, of course, is good for stocks. Let's get to the tail of the tape now. You can pause this. VIX with a big pop up, as I mentioned. Fear and Greed Index has been frozen for 2 days on CNN's website, so it's stuck at 35. I really don't know what the value is. All reliable CNN coming through for us again. Stochastics now with a bunch of red arrows as those the positive days that are being interspersed with negative days just leads to a bunch of chop is what we're seeing now. Bear case now with the break below the 21 for the S&P and the Nasdaq. We'll see if the bounce that we're getting after hours is enough tomorrow to get back above the 21. But that bounce is being kicked off with big tech earnings season, which started today after the close. And we'll start with Tesla. Tesla had kind of warned uh, last quarter on earnings that they were expecting some decreased volume because of some retooling of plants, blah, blah, blah. In other words, they set a negative expectation. They started rallying very clearly here in mid-August. And then they've had a bunch of price cuts. Well, if you're cutting prices, you're decreasing your income, you're decreasing your margins, and Tesla sold off twice since it tried to come out of this cup base. And in particularly, it dropped from 270 to 242 over the last week. After hours, despite missing top and bottom line in earnings, it's rallying. They said the Cybertruck is going to start. Uh, they'll start producing them in the fourth quarter. Whether or not that they really do, it remains to be seen. But also, they cut their cost of goods sold by 5.8% in the third quarter while they were selling their prices decreased by 3.1%. So net, that is a positive impact to the bottom line. And I read another article recently about how their new batteries is going to take several $1,000s out of the cost of making a car. They just keep making technological advances. I would not be surprised if Tesla's the most valuable company someday, but we're not going to guess that. We're going to wait for price to confirm our thesis. And right now, it hasn't been. But it's up after hours on a bad earnings report. I haven't read any details other than a couple of notes that I just mentioned about the cost of goods sold and the selling price. Relative strength hasn't been there, but we'll see what tomorrow brings. But the big winner after hours is Netflix, which beat on subscriber numbers. Their crackdown on password sharing is apparently working. Now, the CFO made some weird comments back on 9/13 that they haven't quite figured out how to make money on this ad tier, and the stock has just sold off nonstop since then. But after hours, up 12%. This 400 level, you can see was a breakout level here, a support level here, and then finally broken here. We're up to 388 after hours, up 12%. I've got an alert set here at the 400 level to see if we can get above that tomorrow. But this really could not have been a worse chart over the prior 6 weeks going into this earnings report, along with the relative strength line. And you can see the big selling. Accumulation distribution of an E is the worst possible by Market Smith. So all the bad news, it's rebounding, recovering, maybe half of that gain, not quite half of that gain, going back to the beginning of September highs. This is another one that gapped down on their last earnings report, then based going sideways before those weird comments on 9/13 by the CFO. So Netflix, uh, That's one of the Big Ten in the FNGS. This is the Big Seven plus AMD, Snow, and Netflix. You can see after hours that's up 1.36%. That had been showing relative strength against the Qs uh, until the last couple of days with the selling that we've seen. Speaking of selling, Nvidia down again today, another 4%, as that government ban on chips just not doing any favors for them. The government ban on selling chips to China, I should clarify, and AMD, same thing, down 2.82% today, not getting hit as hard as Nvidia has over the last couple of days. So where are we? Back to the tail of the tape. So the day count. 5-day consolidation, but we did break a key level, although we're reclaiming it after hours. First day down on the 80 EMA, first day down versus the 21 EMA. Expectations, well, we got to see what our expectations after the action tomorrow. But breaking below the 21, as I mentioned. 10 out of 11 spider sectors down. The only one that was up was XLP. That's consumer staples. That's because Procter and Gamble had a favorable reaction to earnings. Semiconductors, banks, home builders, basic materials and industrials, airliners, biotech, UAL, terrible earnings report, and TEX, which is an industrial. They were down on the bad on the day after reducing their sales guidance ahead of their upcoming earnings report next week, down 9.5%. And this trickled over to Caterpillar and a bunch of other industrial stocks. So more headwinds for the broad market in general. In-house, break back below the 21 meant we took off our U-Pro. 4 buys to this lately, all closed with small losses. The net minus 0.20% to the bottom line. So our stops, keeping us in the game, waiting for a more favorable market. This lowers our beta back below 1. Bottom line on the day, broad selling as yields make new highs, NASDAQ 100 and S&P break below the 21, but positive reaction after hours to, and actually Tesla just must have been said on their earnings report. They're back below 240. Funny how things happen like that, back below 240. We'll see what tomorrow brings, but today, definitely the bottom line. Broad selling as yields make new highs. Not a good day. Seems like the market is taking one step up and then turning around and doing a 180 the next day. But if um, it's really going to come down to the reaction to earnings season of these big names. And we were off to a good start with Netflix winning, with Tesla now it looks like a draw. We'll see how they end up being tomorrow. Let's take a look at a couple of holdings in the portfolio that did not do so well today. They had been holding up, and nothing's still breaking the 21 except just barely on VRT. Hasn't hit the pivot minus 7% level yet. By the way, you can set an alert there just by hovering your cursor in the pink level, right clicking and clicking set alert, and it'll set an alert for you at that pivot minus 7% level. But down 5.9% today. One of the strongest stocks, but if you're swimming upstream against market, you're not going to make any progress. Good day by CrowdStrike, another one of our holdings, still holding up pretty well. Zscaler also down on the day, but still holding up. I mean, if you're above the 80 MA, you're a very clear leader in the market right now, and many of our holdings still are. Nutanix, NTNX, tough day today. Down 2.3%, breaking the 80 MA, but still above this 3671 shelf high. Palantir actually gapped up at the open and then had a bad day after that, undoing the very nice day that it had yesterday, up 2.8%, today down 3.6%, but still above this breakout level of around 1635 within the overall base. That's going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, my partner, Dan Stewart, dan@revereasset.com. If you're watching us on YouTube, I encourage you to create an ID and like the videos. We got a new client today because of somebody who our video just popped up in their feed because of our positive algorithms, and because the algorithm helped us out. They watched the video, said they'd never seen anything like that before, and became a client. So hey, we put these out there. Yes, they're part of our marketing. We've got a lot of people saying they love the videos, but only about 1 out of 20 people, 1 out of 10 people like the videos. Every once in a while people unlike it and then don't leave a comment as to why they don't like it. I can't explain that. If you're not happy with something, tell me what you're not happy about, so we can address it or correct you. Or don't be a coward and just click unlike and then don't say anything about it. But please, do us a favor, log in, create a login, click like on the videos. We reply to every comment that anybody puts out there. They're mostly positive, and I appreciate that. But we'll help you out. You help us out. How about it? And with that, reminder, it's not how much you make in the market, it's how much of that you can keep. Very difficult to make progress in this market. So going back and forth between the growth and protection portion. Reminder, the market doesn't get into serious trouble unless we break below the 200-day moving average. And with that, we'll wrap up the video for Wednesday, October 18th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.